So before we start the Chapter 8 problems, let's just go back over and do a quick review of what Chapter 8 is all about. We talked about two methods of, quote, translating what are essentially subsidiary books of a foreign country. So it's denominated in some foreign currency, we'll call it FC for now, and it's going to get into the presentation currency of the U.S. parent. And that's the goal, because it's going to be consolidated, hence that's why this is included in advanced accounting. When we go to do that, we know that over here, the books and records are kept in the local currency, we'll call that LC, and we can't present the local currency on the books and records of the consolidation statement over here by the U.S. parent. That's going to be reflected in the presentation currency, the PC, which is going to be U.S. dollars. That's the issue. And we have two methods of doing it under U.S. GAAP. The first method is what's called the temporal method, which we're going to study a little bit more when we get here. That's this side. And then the second method is the current method. We looked at these in class. Take a quick look at it, stop the tape, so to speak, and refresh your memory as to the differences between the two. There's some differences where you have historical costs occurring in a bunch of accounts compared to the current rate method, where it doesn't always follow the same result. And then concentrate on this too, because if you concentrate on the circled items, then you're going to probably be able to answer most of the questions when we get to them in just a minute. What I want to follow up on is that in the concepts, we talked about a subsidiary that is one, self-maintained, and then there's a subsidiary that could be under the direction of the parent, so it would be under parental control. Can't watch any unauthorized things on the internet. And the differences between the two is that the self-maintained subsidiary is going to use the current rate method, and then obviously over here, the one under parental control was going to use the temporal method. There are some other languages that get used here, so let's just do that. The current rate method is also referred to as a translation, and this is referred to as a remeasurement. Hopefully the wording of this can become more apparent as we get back to the theory. The theory being the following. If the subsidiary is self, here's the sub and it's self. So when we go to do the translation, so to speak, what we're basically doing is saying, first we're saying, what's the functional currency? What's the functional currency? And if it's self, then the local currency really is the functional currency, because they're conducting all the business in the local currency and deciding how to use it, when to use it, how to pay for it, and they're taking all the control of the local currencies denominated dollars or pesos or whatever it is. So in that case, when we go to do the presentation in the presentation currency, what we're basically doing at that point is we're just translating. What did they do? We didn't have anything to do with it. We're just translating it. So everything comes over pretty much at current rates. Look back to that chart and you'll see that under the translation or the current method, everything pretty much comes over at current rates. And the last thing, which we didn't cover in class, as I sort of ran out of time and then ran out of juice to finish it, is to bring the theory full force or forward complete, is that in this case, if we're just translating, then all the things that occurred over there with the foreign currency is under the control of the subsidiary. So the way we look at it through the translation process, when we have to balance the books, we're going to balance it through the composite retained earnings. In other words, the translation method is going to wind up putting us a little bit out of balance, a little bit out of kilter when we come to balance the books and records. So what we'll do when we do the current rate method and the temporal remeasurement method is we'll sort of I blew that a little bit. This should be retained earnings. What we'll do is in the retained earnings, it'll be what's termed a composite method. We'll just use it as the plug. We'll plug the balance through the retained earnings. But under the current rate method, when the subsidiary is self-serving, it's self-sufficient, that's the word I was looking for, it's self-sufficient, self-sustaining. In that case, they control everything. So any gains or losses that occur because of this plug really just belong to the subsidiary. It's not that the parent controls it, so the parent's consolidated statement shouldn't be affected by it. So the way we do it here under the current method is we start with the income statement. We record everything through the translation process, and then we continue on to the balance sheet. And as we get to the retained earnings, to balance the balance sheet, whatever the plug is, if it's a plus or minus, it goes in there. It goes in the retained earnings. And in order to have the plus or minus in retained earnings, you who paid attention in your intermediate accounting class will recognize that as it's going to be charged plus or minus to OCI, other comprehensive income. So that's the current method. To the income statement, to the balance sheet, plug it to retained earnings, show it as part of the other comprehensive income. It's not really the parent's plus or minus, it's at the subsidiary level. When you do the temporal or the translation method, now we're saying that we have a subsidiary that is subservient, the parent really controls, so it really is the parent. So any gains or losses in the translation, actually this is the remeasurement, it's called remeasurement, any gains or losses that occurred, you got to blame it on the parent. So when you get to the retained earnings, it's going to get charged to income. So here's how. So in the temporal method, this remeasurement process, you start with the balance sheet, you do all your translation there, you go to the income statement, you get down to a number, and you see that that number, that bottom line number, won't balance the balance sheet to the retained earnings, the plug you need. And so the plus or minus will be right on the income statement, since the parent controlled. And that's the difference. You still wind up balancing because the plus or minus gets put into retained earnings, but now this revised retained earnings, which is at the bottom of the income statement, where you have beginning retained earnings and then ending retained earnings, the plus or minus on the income statement will force that to be the right number to balance the balance sheet back up here, and you're in balance. Same way you are, not same number, but you're in balance just like you balanced using retained earnings in the current rate method. You do the same thing here, just a different process as to where you record the plus or minus you need to balance out. And that's pretty much it. So let's go back and just say what you should do is pretty much study the differences between these two and where you have accounts that are historical, where you have accounts that are current between the two methods. This is that remeasurement, this is that translation, and then in the next video we'll tackle the questions of Chapter 8 based on this theory, and then when we find we can't answer any of them based on this theory, then I'll throw the whole thing out.